Let's say they were going to do short-term rentals, or let's say they were going to buy in a small apartment community, or they were going to build a project, ground-up development. Have you done a few of these before? Do you feel comfortable managing this? Because your reputation is on the line. You're dealing with people's money and their life in some certain sense. People might, be diverting those funds from having to put it aside for their kids' college fund. So it's a big weight to have on your shoulders if you don't feel comfortable in what is it that you're doing. So that's the first part you want to figure out. Are you master of your craft? Are you at a stage that you've done this a few times, you understand that business plan, and now you're just in need of capital to do more deals? Then yes, of course, all the power to you to try to go and raise money. And I would say if you have the track record and you can showcase that in a simple pitch deck, and today with lots of AI like ChatGPT or Claude, these platforms allow you to create a great pitch deck for your investors to get comfortable. So get comfortable with your analysis, get comfortable with your numbers, create a pitch deck, and go out there and meet people.
If you've ever wondered how real estate investors actually build their businesses, not just the wins, but the setbacks, the pivots, and the lessons in between, you're in the right place. Welcome to Let's Talk Real Estate Investing, where we have honest conversations about what works, what fails, and what you need to know before your next move. Hi, I'm Debbie Balfour, real estate investor and investor success coach. I help real estate investors fund their deals through a relationship-first approach by building a pipeline of qualified investors who are ready to say yes to your next opportunity. Each week, I sit down with investors and industry professionals to unpack their journeys, key turning points, and practical strategies that you can apply right away. So let's talk real estate investing. Most people say they want passive income, but very few understand how to structure real estate investments in a way that actually delivers it consistently, responsibly, and at scale. Today, we're talking about what it takes to empower investors to earn passive income through commercial real estate. Not speculation, not hype, but discipline, acquisitions, asset management, and institutional level structuring. Joining me today is August Biniaz, co-founder and chief investment officer of PCI Capital in the United States, where he leads investment strategy, acquisitions, and asset management. With over 15 years of experience and more than $225 million in multifamily and build-to-rent assets, Gus brings serious execution to the table. So I'm super excited to have him here today. He's also completed a private equity and venture capital executive program at Harvard Business School. So sharpening his ability to structure deals and attract institutional capital. And he hosts the Real Estate Investing Demystified podcast, helping investors better understand the commercial real estate space. August, welcome. I'm really excited to dive into how investors can truly build passive income the right way. But before we get started, tell us a bit about your journey in real estate.
Well, Debbie, thank you for having me. Your enthusiasm and excitement, it's getting me going. So I'm definitely happy to be here. But quickly about myself and my background. I always say I come from somewhat of a real estate family. My maternal grandfather was a real estate broker. He owned his own brokerage firm. And my mom always dabbled and invested in real estate. So if real estate was a language, I understood it from an early age. So it was just a natural evolution for me to get involved in real estate. So I got my real estate license in my early 20s. I didn't really see myself being a real estate broker as a career, but I really loved real estate and the deals that were to be had. So I started doing small fix and flips right away and made great profit in those fix and flips. I'm originally from Vancouver, and the Vancouver real estate market had done tremendously well from 1995 to 2015, real estate prices have gone up 500%. So you were really just riding the wave. And at some point from fix and flips, I moved on to start my own general contracting company and start building homes. I did both custom and spec homes. A custom home is when a client hires you to build them a home to their specification for their use. A spec home is when you build a home and you put it on the market and you sell it for profit. So I did that for close to a decade. Always wanted to scale, always wanted to do bigger projects. And that kind of resulted in me looking at doing larger developments. I did a townhome development at some point, but I realized that I would run out of my own capital at some point and I needed to raise more money. And when I started educating myself in the space of real estate private equity and syndication funds and other vehicles, I was introduced to US real estate. And I felt that because of the high yields, the U.S. real estate, and because of the tax advantages, because of the friendliness of the government on the U.S. side, I felt that we had a competitive advantage bringing U.S. deals, commercial real estate deals, to Canadian investors, which was the result for us to start CPI Capital with our mandate to invest in U.S. real estate while partnering with Canadian investors. So that's a bit about my background.
Amazing. And I'm excited to get into this because here's an opportunity for someone who doesn't want to literally go out there don't know the US market, don't know, where to start, but can still invest in Canada in the US market because we know it's much more profitable and much more, many more deals out there than we can get here in Canada. August, before we get started, let's give a crash course to our audience about multifamily and about the build to rent.
Yeah, of course. So multifamily is an asset class under the commercial real estate umbrella. In commercial real estate, you have multifamily, office, retail, hospitality, student housing. There are a lot of different industrial. There's all different asset classes, but multifamily is one of those asset classes, both in Canada and the US. So these are apartments. Usually the institutional size we're talking about are over 100 units. So as soon as a building or a community has more than 100 units, is really institutional. What that means is institutions are buying these types of properties. And when we talk about institutions, we're talking about real estate funds, REITs, which are public or private REITs, private equity companies. So these are large institutions or family offices in a lot of cases. That's the asset class we're discussing as far as multifamily goes. Now, as far as how these deals are structured, so institutions, they raise their own capital or they have their own capital and they come in and invest in multifamily. And the profit in multifamily is created through the yield that the project produces. So if you are buying a 100-unit apartment community and that produces income through the rents that it collects, now you have certain expenses, you have your debt payments, other costs, and whatever your net that's left over is the profit that you're making. It's also known as a cap rate that the property produces. So that cap rate is a return on investment that exists for investors investing in multifamily. Now, multifamily value add, which is a subsection of multifamily, and multifamily has core plus value add and opportunistic types of asset classes. And for value add, the business model there is not only you're purchasing a piece of real estate, be it an apartment community, and you are receiving those yields that the property produces. On the value add side, it also allows you to go in there and actually force appreciate the property. What that means is you go in, you do renovations. If there are some delinquent tenants or troublemakers, you get them out of there. If the marketing is not doing a good job and you don't have a lot of leads coming in, you bring in a better marketing team, better sales team, a better management team, and you make the property perform better. Just as if you were buying a business, you make it perform better and you increase the profits that the property produces for yourself or your investors. That's on a high level how multifamily works. On the build to rent side, now build to rent falls under the multifamily asset class as well. It's somewhat of a newer asset class. So rather than going and buying a apartment community or going and building an apartment community, build to rent is when investors build purpose-built rental single family or duplexes. So buying a piece of land, getting that all entitled and rezoned, and then building a community of single family homes for the purpose of rent, or a community of duplexes. And the business plan there is you build it, you start occupying it, so in turn stabilizing it. At some point, either you refinance from your construction debt into a permanent debt, and you either exit at some point or you hold it long term. So they're very similar, but definitely distinguished asset classes.
Wonderful. So I love that, when I heard build to rent, that was not what came to mind. I thought you were actually building multifamily to rent it out. So thank you for defining that for us. That's when you mentioned opportunistic as a class. What is that?
Yeah, so when you look at multifamily, you also hear people saying A class, B class, C class in multifamily as far as the property type. You hear that very often, but when you look at it more on an institutional level, finance level, the categories of multifamily are broken down into core meaning pretty much a brand new property that's been either built uh, uh, just now or very recently. You have core plus, which is maybe around 5 or 10 years old. And anything above that, more than 10 years and older, is called opportunistic. And then you also have, well, forgive me, that's value add, but opportunistic is more a situation where it's class D apartment. So workforce housing is opportunistic. If you have a distressed asset, is opportunistic. A property that's in trouble in some cases, and so on. So that falls under the opportunistic category of multifamily. So class D, as is also known if you simplify it. So it goes core plus, value add, and opportunistic. So class A, class B, class C, and class D. So opportunistic could possibly, it's not only the vintage of when it was built. So but for value add, anything 10 years or older, which is in need of some level of renovation, is value add. But opportunistic is about really, is the asset older? Is the asset has a lot of deferred maintenance? Is there, the asset is in some level of operational distress that somebody has to come in and save it? So that falls more on the opportunistic category.
Tell us a bit about how can Canadians invest in your fund that's actually opportunities all based in the US.
Yeah, I mean, Canada and the US have a treaty which allows Canadians and to invest in the US and reciprocate it for US investors to invest in Canada. The tax treaty allows Canadians to invest, and they have to pay their taxes to the IRS. But the IRS, the CRA rather, recognizes those taxes paid, so they don't have to be double taxed. So it allows for that flow of capital between the two countries. When it comes to an investment firm like CPI Capital that allows our investors to invest into our deals in the US, is through a cross-border tax structure. So we create a Canadian entity, which is in most cases a Canadian limited partnership. Our investors invest into that limited partnership. Now, this entity, this vehicle is project specific. So let's say for example, we have a current deal called Apollo Meadows. It's a BTR deal in San Antonio. So the first thing we do is we create actually our US entity, which is a US limited partnership. And that limited partnership is the entity that owns the property. So all of our US investors invest directly into the US limited partnership. And then at the same time, we create a Canadian limited partnership, which is just another vehicle here in Canada. The Canadian investors invest into the Canadian limited partnership. And then the Canadian limited partnership as an entity invests into the US limited partnership as an investor. A limited partnership is just another vehicle alongside a corporation, a limited liability partnership. So these are all entities that can be used to structure deals. Some of them are very efficient for real estate. So in Canada, a corporation is somewhat efficient. A limited partnership is probably the best entity to use when you're bringing on investors. In the US, they have more entities than we do in Canada. For example, in the US, they have LLCs, limited liability companies, which is an entity that we don't have. It's somewhat of a hybrid entity between a corporation and limited partnership. So there's other vehicles as well. For example, in Canada, we have a vehicle called the Mutual Fund Trust. It is somewhat a difficult vehicle to put together and somewhat costly and expensive to try to just do it for one deal. We have mixed mortgage investment corporations that are mainly used to raise capital for example, the debt fund. And debt funds in Canada are mostly called a mortgage investment corporation. So these are all different vehicles you could use to structure your deal to then raise money from investors. But for the case of CPI and more larger investment firms and private equity firms, a limited partnership is probably the best vehicle to use. So every time we have a deal, we create a US LP, we create a Canadian LP. Our Canadian investors invest in the Canadian LP. Our US investors invest in the US LP. And then the Canadian investors invest in the Canadian LP invest in the US LP just as another investor. Each one of these limited partnerships have their own offering documents. They file documentation with the security commissions, both in Canada and the US. So they're very well regulated, and we follow those guidelines, the security commission guidelines, and the exemptions that exist for us to be able to raise capital for our deals. So yeah, that's pretty much it on a high level.
A lot of investors in the last 2 or 3 years have really been burnt by the smaller, groups that have, come together and done a development. We even had a mortgage broker with a huge following there, supposedly trustworthy, that lost a lot of money. And then we even have some of those syndicated mortgage groups that have also now stopped paying on their investments. So how are you protecting your investors?
Yeah, just touching on the earlier part of your question, I want to say that real estate is cyclical, and it continuously goes through these cycles of recession, recovery, expansion, and hyper supply. So as it goes through these cycles, it causes distress at times. So what we're seeing today and over the last few years, the distress we see in the space is as a result of the market cycle that we're going through. So that's not only happening on the side of the newer syndicators who've got themselves in trouble and have lost their investor equity. You see that happening on the larger institutional side, where some Canadian apartment REITs are, stopping distributions. You've seen it on even Blackstone's $10 billion real estate fund, basically locked up redemption, so they didn't allow people to redeem their funds, because real estate is not only analytical as far as numbers and math, it's also emotional as well. So when you have investors having concerns and the sentiment is down, sometimes they pull out their funds from these investment vehicles, which causes even more distress. So yeah, that's been happening. Now, is there a situation where a syndicator or a fund manager was too eager? Maybe they were newer in the space. Maybe in some cases they were even unscrupulous and they have caused some losses to investors. That always happens in the space, and investors need to be cautious of that. As far as us with CPI, how do we try to lessen the risk that exists? Obviously, these investments are always risky, and they come with those caveats that investors have to do their own due diligence. But the first thing you want to do is you make sure that you're not dealing with somebody that's unscrupulous, something that's fraudulent. You want to make sure that it's a reputable group that you're working with. Then you want to lessen the risk as well to make sure that group has the track record that's needed and the experience, and make sure that your jockey who's riding the horse being the real estate market, jockey being the sponsor, the general partner, knows what they're doing. Some things we've done over the years, from 2022 to 2024, when the US central banks and the Canadian central banks were on a tightening cycle and they were actually increasing interest rates, and it seemed like the market was really in a bust cycle, we stopped doing deals. So we sat on the sidelines for 26 months without doing a single deal in that time period. So that was one of the steps we took. The second thing we did is in July of 2024, when we closed on our deal, Atlas at Bay Point, which was a 126 unit apartment community in St. Petersburg, Tampa Bay, we actually knew that there was a lot of debt distress deals in the market, and a lot of people had got themselves in trouble for putting high octane debt on their deals and highly leveraged debt on their deals. Decided, and we elected to put a low leverage 55% LTV loan on that deal. We got that loan from Freddie Mac, that is the CMHC of the US. US has agency lenders similar to CMHC, but there's two of them. There's Freddie Mac and Fannie Mae. So we got that loan from Freddie Mac, which is a government agency, so it gives you better rates. And we got it for 5 years at a fixed rate. So we try to de-risk the deal, not to try to financially engineer the LP economics, the investor economics, by putting a high octane debt on the deals. And we went back to our operations, making sure that the deal is being operated right, making sure we keep our occupancy high, making sure we're on top of our property manager and our team, making sure that the turnovers are done in a rapid time period, and so on. So, but also along that time, we're also educating our investors about where the market is, what part of the cycle we're in, what we're seeing out there. So as general partners, as fund managers, we were fiduciaries to our investors, and at the end of the day, our reputation is on the line for the deals that we do. So it's hard enough to try to survive in this space if you have the stigma of having lost investor money, or a bad feedback about your firm even makes your business and life harder.
It's hard to recover, definitely. Once you lose your brand, it's so hard to recover your brand.
Just
Point
one
there.
quick one quick point on that. So I don't want to be the advocate from anyone who's lost investor money. The point I'm trying to make is that it happens across the space, especially when you go through these bust cycles. But it's important to distinguish between unscrupulous groups
Unscrupulous,
that were
exactly.
too aggressive and they weren't fiduciary to their investors. They just wanted to do deals because as general partners, we are compensated through fees that we collect when the deal closes, but a
Mm-hmm.
majority of the profits are made on the back end when the deal is sold from our promoter, the carried interest on the back end. Sometimes firms get used to getting those acquisition fee and asset management fees coming in, and they've also got a lot of great talent that they have acquired. So when they're not doing deals, they're paying those. They're paying those costs and salaries to their talent, and then they're like, "Oh my God, I haven't done a deal in a year. We better do a deal now, otherwise we're going to lose our talent." And I've seen a lot of big firms letting people go as a result. So it's important to distinguish between somebody who is unscrupulous, somebody who is
Or bad
being
at
too
business.
aggressive, bad at business, somebody's being too aggressive, definitely, or somebody who's doing just deals for the sake of doing deals. But
Yeah.
as an investor, that's one of the homeworks you have to do. Get referrals. The transparency is the most important thing. When you get on a call with a general partner, you have to see their transparent, and you have to go with your gut feeling. If you have a good feeling about someone, make that decision. Then you can always dip your toes in, and you don't have to put the whole bank and your life savings into a deal. You can start, our minimum investment is $50K, so you can start there and see, hey, does this make sense? Are they reporting good enough? Are they getting back to me? So for example, with CPI, one of our company policies is to get back to investors within 24 hours, no matter what it is, no matter how complex the question is. Even if it's a tax question, we always get back to them within 24 hours. We might not be able to answer your question within 24 hours, but they'll get a call back or an email back from our investor relations team, letting them know that they're on top of the file, and they'll get back to them with the question that they have.
So you went deeper into that. Now is about that the people that you're investing with have the experience of investing, and also communication is key, because that's the first thing that disappears. Like, people tend to, when something goes wrong, they want to bury their heads in the ground and not communicate because they don't want to face the elephant in the room. The other thing you mentioned about when the interest rates were high, you paused on it. I hear everybody saying it's not a good time to invest. It's not a good time to invest, even now. And what you just said is that if you have liquid money, if you've got money to invest, then this is a time to invest.
No, I'll answer that in two ways. One is it always a right time to invest, be it real estate or any other investment? Is there a time that you should just not invest and sit on the sideline? I mean, today feels like that time, right? You have geopolitical issues with the war in Iran. You have interest rates that are relatively in kind of recent time, they're relatively pretty high. You have concerns with AI and job losses that exists. So you have the Trump's administration with tariffs around the world, which are inflationary. So you have all of these macro concerns happening around the world, which causes some distress and concern. You have the equities markets that have done tremendously well, which always almost makes you feel like, is there a bubble about to burst as a result of AI and too many AI companies coming up? There's also some concern with private credit, which is the way that all of these new AI startups have been getting funded. Um, you can feel that in the economy currently, we might be either close to recession or coming onto a recession. But on the real estate side, well, real estate has been in a recession since 2022. When the central banks, then the COVID hit, central banks realized what is happening because they had to lay everybody off and everybody had to go home. So they literally had to print money and send it in letters to people's homes and deposit in their bank accounts. And people sat at home and start spending all that money, which was inflationary. People spend a lot of money, consumers spend, then suppliers are going to increase their prices, which was inflationary. U.S. inflation came almost all the way to 9%. Healthy inflation in the U.S. is 2%. So, and what that resulted in happening is that central banks, for example, the U.S. Fed, started increasing rates because one of the levers they have to battle inflation is by increasing the Fed's funds rate. So they started increasing the Fed's funds rate 11 consecutive times, going from 0 to 0.25 all the way up to 5.25. And that in itself, increasing the Fed's fund rate at such a rapid pace, resulted in the whole U.S. economy slowing down a bit, right? Because the rates were increased. Is more expensive to borrow money, so less people are going to start business, less people are going to buy equipment and supplies, less people are going to buy real estate, like for example CPI not buying anything from 2022 to 2024. That really slowed down the market. Now in Canada, you also had issues when it came to people complaining about too much immigration taking place here, and in I think in the last 12 months our immigration has gone, or in 2026 it has been zero compared to 1 million people in 2025 and 1 million people in 2024. So slowed down it's caused the condo markets in Toronto and Vancouver to completely implode. So you've had this perfect storm when it comes to real estate, and real estate has been in recession since then, when commercial real estate in particular is very sensitive to rates. So if the rates are high, then your buying power is lessened. So we've seen a correction in commercial real estate prices on the multifamily side around between 20 and 40%, depending on some markets, right? Some markets like Jacksonville, multifamily value add prices went down 40%. Markets like Tampa, they went down 20%. Markets like Austin and DFW have gone down 30%. Same thing with rents. Same thing with occupancy as well. You've had lots of cheap debt. So a lot of developers went out there in Canada and the US and they built a lot of supply. Supply came online. And because there was too much supply, it had a downward effect to rents and occupancy. So there's a perfect storm. So are we today in the bottom of the market? Is it the bottom of the market? Because we know real estate is cyclical. I will say that either we're very close to the bottom of the market, we're either at the bottom or just past the bottom. So if real estate was a clock and 12 o'clock was top of the market, where it's absolute mania, people are writing multiple offers, people are putting non-refundable deposits day one, that's your 12 o'clock. And then your 6 o'clock is bottom of the market. People are losing their shirt, investment firms are pausing redemptions, syndicators are going belly up. So I would say today is much closer to 6 o'clock than 12, of course, right? Anybody logical would understand that. Is it a right time to enter and buy deals? It really depends on your business plan. Is your business plan long term? Are you planning to buy a multifamily property? Are you buying it at discount price to where prices were in 2022? Does the market you're buying, is your tenant base rent burdened? Can they afford the rents you're looking to, increase the rents over the next 5 years? But if your time horizon is a bit longer, if you're in a market that has those fundamentals for job growth, population growth, income growth, and so on, then I think is the best time to get into real estate. But if you're there for, a short-term rental business, or if you're there, which has had lots of issues, short-term rental, or if you're looking to do a CMHC type of build, I mean, a lot of those started popping up all over Canada and in Alberta and other provinces. Is there concern for some oversupply coming online? So you have to see what is the beast you're trying to wrangle. What is the business model you're trying to execute in real estate? But I think today depends on what business model you're utilizing, what asset class, what part of real estate, and it could be a great time to be in the market today.
So, August, there are lots of people out there wanting to raise capital. They see opportunity. There's lots of people still doing development, but they need investors because they don't have that kind of money to build this. So how do you launch a real estate private equity firm from the ground up?
Yeah, no, good question. I would say, I'll tell you a story kind of about my background. So I was a home builder, as I described in my, background when you asked me that. Over my tenure as a home builder, I had made a lot of people a lot of money, millions of dollars, a lot of my clients, a lot of people I worked with. So I was very well respected and very well known. When I started CPI, that's the network I started connecting with, saying, hey, I have these opportunities in the US. You can be a limited partner and you can make a minimum of $100,000 investment. But a lot of people, the conversion wasn't there the way I expected. I'm like, hey, I've made these clients millions of dollars over the years. they have no problem coming and putting couple $100,000 with me as an LP, but I hadn't taken the step of educating my clients. They had no idea what an LP was. They had no idea what private equity was. They had no idea of this passive type of investment. They're usually pretty active investors. So I had misstep or jumped over that step of educating my investor base. Also, I didn't realize that maybe they're not the right profile of investor who invest in these types of private product, these types of exempt market product, as it's also known as, or private equity type of deals. So when we went back to the drawing board at CPI, and we put a lot of attention and focus around the capital raising, investor relations, and how we're going to raise tens of millions of dollars over the years, which we have. And we really started working on the brand, not only the brand around the company, but the brand around each one of our executive team members. So there had to be a brand built. If somebody does research about you online, do you even exist? Are you an expert in your field? Are you creating content? Today, if you're not creating content, you don't even exist. So we had to go on that pursuit of building a brand around ourselves, educating ourselves, live, sleep, eat the space you're in. So going to conferences, networking. And then we started working on our internal infrastructure when it came to the back office, when it comes to investor portal, when it comes to CRMs, when it comes to a lot of different efforts, because just by creating leads, that doesn't translate into investors. Let's say that you went to a conference and you connected with 10 great individuals that might potentially invest with you if you have a deal. You had a great talk with them, you had coffee with them. Then what? What, you're just going to have them in your phone or put them on an Excel sheet, and then 6 months later when you have a deal, you give them a call. They're not going to even know who you were. They're not going to remember you. So how do you do that? What is that process for? So that's where we went. We copied a lot of great models from a lot of institutions of how they achieve that and be even better at. So for us, we have a lot of these different systems and processes, a lot of these initiatives to bring in leads, if it's through our social media content, if it's through our podcast back here, Real Estate Investing Demystified, if it's through LinkedIn, if it's through networking events, if it's through conferences, all of these leads are generated. Those leads are then imported into our CRM. And then we have investor relations team members that reach out to these individuals, or the team member who connected with them directly, and they build a relationship. They find out about what is their goal as far as investing? Do they have liquidity? Do they even qualify as somebody who can invest with us? Because most of people that invest with us have to be accredited, and in Canada and the US. So are they accredited? Do they have liquidity? Do they understand the product that we offer them? So they do a qualifying and kind of that connection type of call with them. And then we have a nurture process. So you've met these 10 individuals, you've had a phone call with them, you've qualified them, they do have the liquidity, they do have the accreditation to invest with you, but how are you going to be on top of their mind until you have a live deal in the future at some point? So that's what we created our nurture process, which is creating ongoing newsletter. Every Sunday at 6 a.m. Eastern, we send out a newsletter that does a summary of what has been happening in the prior week when it comes to real estate, commercial real estate, the economy. So they get that in their inbox every Sunday at 6 a.m. So that keeps them keep us on top of their mind. All social media content we send, again, they see us on their social media when they go there as well. And then we host our webinar masterclass once a month. We're bringing on an expert and discuss different topics on wealth building and different ideas that they could utilize for their business and for their life. So that's what you do. So when you do have a deal, eventually you then get it oversubscribed, like we've done on every one of our deals. I would say also in that 26-month period from 2022 to 2026, when we were not doing any deals and we were sitting on the sideline, we never turned off the capital raising or investor relations tab. We were out there connecting with investors. We were out there nurturing investors. We were adding value to our investors because we knew the market was going to turn at some point for us to be able to achieve that again, be able to have to go out there and raise money again. So yeah, happy to explore that farther, but that's on a high level how we've achieved being able to raise tens of millions of dollars over the years.
I am so excited about what you just said because it's what I've been trying to teach my clients. It's exactly what I've been saying. And I love what you said, that the mistake you made at the beginning was just thinking that these people will invest with you. But what you had to do was, first of all, you had to educate them. So giving that value, educating them so they understand what it is you do, where you're investing. And then everybody in your team had to get out there and get known and build that credibility. So many people I hear say, oh, I don't need to be on social media until I have a deal. And it's too late by then. And look at you guys. We were on the sidelines, but you were out there still talking
For
to
sure.
people, still educating them, still giving value.
Yes, one more important point to make is that it was also who I was in their mind. I was a home builder. I was a Vancouver home builder. I was a local general contractor that they knew, somebody who was an expert in that space. So when I brought them a deal in Florida, a multifamily deal, and it was an LP type of investment, it didn't make sense to them because they didn't see me as that guy. So I had to rebuild my brand. I had to rebuild my expertise. I have to be that individual who's an expert in that space for them. So, and that takes a process. You can't today be a builder and tomorrow be a general partner of multifamily. And that goes for any other space. You work with a lot of fund of funds or co-GPs. These are individuals that have their own audience, but might not have the infrastructure to be able to go out there and acquire deals and sign on the loan and analyze deal and underwrite deals and then also execute the business plan. So they come and partner with us and they bring in capital to our deals and some brain power to our deals, and we profit share with them our GP economics with these individuals. But a lot of these individuals are experts in their own space, but they themselves also have to educate their investors that, hey, there's this new venture I'm involved with. It's to do with U.S. commercial real estate. I've already done a deal with these guys in the past and it was profitable. I can vouch for them. And I've been doing this now for a while. So yeah, there is a period of time that not only the education, but you have to also be that experts that the people that you have around you either trust you enough to invest with you or trust you enough to partner with you with other joint venture partners.
And a savvy investor will look at the team and say, okay, what are they doing? And do they have that experience? So you need to have that credibility. And it's not enough to just have one conversation. Right. Like you were talking about, you go to a networking event and you talk to someone and you have a great conversation. But then what people go home and do is research that person. They'll Google you. And if they can't find anything about you, your credibility just got lost right
Yes.
there.
Hopefully you'll be lucky like me and Debbie, and you'll have a very specific name, because generic names, you would Google it and it's going to be all these other names come up. But yeah, usually if you're involved in a certain asset class, multifamily or short-term rentals or industrial or fix and flips, if you just put the person's name and you put that, usually content comes up online, but on different social media and podcast platforms and YouTube and so on. But yes.
Awesome. Just a little switch here. We mentioned the word syndication before, like syndicated mortgages and syndicated groups. Can you define for our audience, what do we mean by syndication?
Yeah, syndication is basically a type of partnership where there are two different individuals. So there are these investors that are putting up the capital needed for a project. And then you have the general partner, sponsor, fund manager is the person who is managing the project, and they come together. This process is called syndication. So if you're buying an apartment building and you're then going out there and raising money from a group of people, that's called you're syndicating that deal. It's just it's a terminology for the process that takes place. What vehicle is usually used in a syndication? Either a corporation, LLC if it's in the US, or a limited partnership if it's a cross-border or a Canadian entity. I think a limited partnership is the best entity to use. But that's the vehicle you use. The process of what you're doing is a syndication because you're raising money. To expand on that, if Debbie and August want to go and buy an apartment building and they're putting up their money and they're going 50-50 when it comes to the work that is needed and the capital that's needed, we're doing a joint venture. That's not a syndication because it's just two of us. We're doing a JV. That's a joint venture. If we're going out there and raising money from a group of investors, that's called a syndication. We are syndicating that deal. And now if we want to continuously raise money, use a vehicle, one of those vehicles I mentioned, probably a limited partnership, and you want to continuously raise money and continuously buy deals within that same vehicle, now that's called a fund. That's no longer a syndication, because the syndication is usually project specific. It's one deal. We are syndicating buying this apartment building. But when you want to put together a fund and continuously raise money and continuously buy more deals, now you're launching a fund. You've now put those deals into a fund. And funds usually have a 10-year lifespan. The first couple of years, you go out there and raise the money and start buying deals. The next few years, you execute the business plan, and the last few years, you sell those deals and you wrap up the fund. That's a closed-end fund. You can have an open-end fund that you can continuously buy deals and continuously divest, and union investors can come in and go out as they see fit, depending on your offering documents. And then as these vehicles get more complex and larger, then you go into a REIT, a real estate investment trust, which in some cases are public. So there are public REITs where you can go and buy apartment, shares in apartment buildings. Public REITs, the difference between syndication or a fund and a public REIT is that public REITs have a liquidity. So you can go online and press a button and sell your shares. In syndications and funds, they're illiquid. You're in the project depending
until
on the
the end.
redemption rights until the land. On a syndication, you're there till the deal is divested or is concluded. In a fund, there are some funds that do have redemption rights, but on a 10-year closed-end fund, you're in there for that 10 years. In most cases, there's no redemptions. Open-end funds have redemptions rights. Now, why doesn't everybody then invest in REITs? Why bother with syndications, joint ventures, or funds? Is because the yields that are available in public REITs are much lower. Their profits are much lower than funds and syndications. And you're also taxed differently for public REITs. You're taxed as an ordinary income, whereas in funds and syndications, you're taxed at capital gain. So it's a lesser tax burden when you invest in syndications and funds.
So what would be your top secrets for someone wanting to first syndicate their first deal?
I would say a couple of, I mean, if I was just sitting with them and they were asking me for advice on what to do, I would really say that have you mastered whatever your business plan is, right? Let's say they were going to do short-term rentals, or let's say they were going to buy in a small apartment community, or they were going to build a project, ground up development. Have you done a few of these before? Do you feel comfortable managing this? Because your reputation is on the line. You're dealing with people's money and their life in some certain sense. People might, be diverting those funds from having to put it aside for their kids' college fund. So it's a big weight to have on your shoulders if you don't feel comfortable in what is it that you're doing. So that's the first part you want to figure out. Are you master of your craft? Are you at a stage that you've done this a few times, you understand that business plan, and now you're just in need of capital to do more deals? Then yes, of course, all the power to you to try to go and raise money. And I would say if you have the track record and you can showcase that in a simple pitch deck, and today with lots of AI like ChatGPT or Claude, these platforms allow you to create a great pitch deck for your investors to get comfortable. So get comfortable with your analysis, get comfortable with your numbers, create a pitch deck, and go out there and meet people. And when you meet investors, tell them what it is that you do. Become that expert. Be in people's minds of, hey, this individual is that person who buys small apartment communities, small multifamily in Ontario. Be that guy, be that expert. And as long as you do good work, your investor base will grow. Definitely get a CRM is extremely important. The CRMs have so many functionality. You can put detailed notes about your investors on those CRM. You can actually build your emails that go out about either a deal or your update emails on the platform itself. And partner. A lot of times bringing on a great partner is great because you might not be at best at everything. To be able to go out there and raise money to manage a small boutique investment firm, you need to have the acquisition figured out, how to analyze deal, relationship with brokers, and so on the deal front. But then you also need to understand how to execute a business plan. If it's property management, if it's asset management, making sure everything is done correctly and on budget. And then you have the operations, investor relations, marketing, bookkeeping, accounting. So it's hard for one person to do all of that. Maybe it's time to find a partner who excels at something else. And a lot of these networking event or coaching platforms are great for that. There's a lot of things you can learn on there, but you can also go on there and meet that perfect person who basically completes you and
Compliments
brings
you.
on complements you and brings on what you need. Maybe they're great at analysis. Maybe you're great at being on site and dealing with contractors. You're great at project management. They're great at something else. Maybe they have a big network of investors, or they're great at being on front of the camera and you can be in the back office while they're there creating content for the company. So partnering up is also another great advice. So yeah, I would say initially master your craft, start building the infrastructure for investors and the CRM and the tools and using Claude for a pitch deck, and then probably also bring on a great partner who complements you.
Excellent. Those are some great tips. So what would you say to first, let's talk about the other side, a passive investor. So what are some tips would you give? What are tips that you would give to them if they're looking to invest in a passive investment?
Yeah, so I mean, I think the term passive investor or passive investment has been used by a lot of firms to create this facade that this is just passive. You click a button and everything is done on your behalf. No, the process that is needed to be able to audit and do your due diligence on an investment firm, that's not passive. That's going to take a lot of time to talk to different investment firms, ask them questions, see if they're transparent, see if they're sharing details with you, going out there, even finding who you want to invest with, making a decision of what is it that you invest in? What do you believe in? Do you believe in US multifamily? Like if you ask me as an investor, why do I believe in US multifamily? I believe in it because over 1/3 of Americans rent, 342 million population US, over 100 million Americans rent. Over 10% of the US population lives in apartment communities. And that number has been continuously growing since World War II. The number of people living in apartment communities have been growing. And now because of where interest rates are at, there is a burden on people trying to get a mortgage compared to renting. There is for a medium home price mortgage or a medium similar place for rent, there is currently a $700 delta between owning and renting. So, and that's on putting down 5% for somebody buying a property. So it makes much more sense renting. And US is becoming more and more of a renter's nation. So as an investor, I believe in multifamily because I can see those fundamentals. The next step for me is to find out who are the investment firms focused on multifamily. How do I want to have exposure to multifamily, and doing the homework on who I want to invest with. Next is how much do I want to invest? Do I want to put my whole life saving into a multifamily deal? Absolutely not. Being savvy, using my registered funds in some cases that are sitting around collecting dust, self-directing them into a deal, making sure the firm that I work with, accepts registered funds for investments, dipping my toes in, see how their reporting is. At the end of the day, whatever business model that you believe in, whatever is the asset class you believe in, should be as part of your diversified portfolio. You shouldn't have all your eggs in one basket. You should have equities. You should have other investments. You should have a rental property. And at the same time, you should have some allocation to the private equity type of investments in real estate, and work with a group and see how they perform and keep investing more with them. So that would be my advice to a retail investor looking to have exposure to private equity type of deals, be it multifamily or other asset classes. So believe in it, first of all, know what you want to invest in, do your homework, know this is not going to be passive. You have to do your due diligence and homework, who you want to invest in. Don't invest the whole house on them, and then increase your allocation and be diversified.
I love what you said. It is so true. People use that word passive investing as though it's like, I don't have to do anything. And that is so wrong. That's such a misconception. Passive investing just means you do the work up front and then you reap the rewards later. But you do have to do that work up front. And I think that's where we find a lot of people that have lost their shirts. They've done the things that you said not to do. They haven't investigated the people properly that they're investing in, or they put all their eggs in one basket and put their whole life savings in with one company. And the other thing is, a passive investor also niches. Like you said, do you believe in? And in like, what asset class do you want to be investing in? So you need to pick something and believe in it.
Exactly. You don't have to pick anything. Is there something that you like? Is there something that you feel that you want to put your hard-earned money into because you feel like it's going to be doing great? Then have
Mhm.
the conviction to invest in it. Just find the right partner, find the right jockey. The horse is multifamily. Now find the right jockey who's going to run that horse for you.
Excellent. Thank you so much, August, for your time. So many great nuggets. I love it. I knew I was excited to talk with you, and you haven't proven me wrong.
My pleasure.
So
My
thank you so
pleasure.
much for your time. How can people get in touch with you?
Yeah, our website, cpicapital.com. We have a lot of great information on there. There's a back of the envelope underwriting model they can download and try to underwrite multifamily deals if they wish. We have the recording of our webinar master classes we hold every month only on our website, access on our website. A lot of our other great information, questions to ask a general partner before investing with them. They can download that as well. So, and you have also a link to access our podcast from our website. So a lot of great content on there. Personally, I'm very active on LinkedIn. I'm a LinkedIn top voice, which is invitation only. So I create a lot of great content about the economy and commercial real estate and multifamily and BTR. So connect with me on LinkedIn, August Biniaz on LinkedIn. And I'd love to book a call and get to know you and add some value to your journey in investing. Awesome. Great.
Thank you so much for your time. For everyone listening, be sure to check out all of August's resources. Check out his posts on LinkedIn. So educational. And I just have two things to ask you to do. If you enjoyed this session, please hit that like button. And the second thing is subscribe so that you can get notified when the next podcast is being released. So thank you so much for your time. Thank you, August. I really appreciate it.